Hello, friends, clients, and colleagues. This is Rich Siegel with ARQ Wealth Advisors, and today is Sunday, March 24th. I took a quick break from the NCAA tournament to do a brief market video, and today we'll just be focusing on the Fed and rates and also the stock market. This is our disclaimer language. Take a quick read of that if you'd like, and scroll on down here to one of my favorite charts that JP Morgan puts out. And it shows the Fed funds rate. That's what Jerome Powell and the Fed controls. And right now we are at about 5.4%. There's a range, 525 to 550. So they put 538 here. Their long run target is down to about 2.6%. And they think we'll hit that in just a couple of years. Last week was a big week. The Fed statement came out after their meeting. And Jerome Powell basically sounded dovish, which basically means that they are telegraphing that they're going to cut rates about 3 times in 2024. And the market liked that and reacted very positively. Both stocks and bonds did. So you can see over here that the FOMC, the Fed, their estimate for year end is about 4.6%, meaning that all money markets and CDs and cash rates are going to start coming down sometime this year, and then a year later about a year and a half later, under 4%. So the days of this zero Fed policy is probably over for this generation, hopefully. But a migration towards more normal rates. They lifted rates this high, obviously, to offset, to bring down inflation. As far as the stock market goes this year, off to a really good start, surprising start. The end of last year was super strong, November, December. So usually when you have that type of market run, things cool for a bit. This year, the markets reacted positively to a couple of things. One is better than expected economic data. That's one. And two is the most recent news with the Fed and its dovish comments about lowering rates 3 times. So is the market priced to perfection? We think so, yes. The market's trading at pretty high valuations, and it wouldn't take much to have a correction. Corrections happen quite often. 5% pullbacks happen about 3 to 4 times per year normally, a 10% pullback about once a year, and then a real correction greater than 10% about every 18 months on average. 14% pullback is the average correction above 10%. So you can see here this year that the S&P is up almost 10% in under 3 months. Pretty shocking. The equal weighted version of it, not cap weighted towards 10 stocks, is still doing quite well, up 6% plus. These are the Mag 7 stocks, Magnificent 7. Now, don't forget, these stocks were down 46% in 2022, had a stellar year last year and got all the losses back. And then this year we have a mixed bag. You can see NVIDIA, based on this tremendous hype on artificial intelligence, 90% return this year. Tesla is having a rough time, down 31%. Apple, down 10% plus. Microsoft, Amazon, Google, Meta, which is Facebook, all doing pretty well this year. Now keep in mind that these price to earnings ratios are quite lofty. Historically speaking, the price to earnings ratio of the S&P sits at around 16.6 times, and today it's at 21 times, mostly driven by the tremendous performance and high valuations of 7 or 8 stocks. The broader not cap weighted index, equal weighted index, is trading at 17 times earnings, which is more typical of the stock market. There are other areas like foreign equities and small caps and mid caps trading at much lower valuations. So overall, we'd say this, that the S&P is probably a little bit frothy here for sure, and that other parts of the markets are looking more reasonably valued and in some cases quite cheap. We have exposure to these stocks, just not in the same concentration as the S&P. We think that could be a short-term problem. Now, the good news is that the market is broadening out. You can see here that the S&P kind of dominated January, did really well in February, but all of a sudden now in March, we're seeing foreign stocks and equal weighted S&P start to slightly outperform the cap weighted S&P. And then if you remove January, what's really interesting is for the last couple of months, S&P up 8, but these value cheaper sectors, materials, industrials, energy, are all outperforming the broad S&P 500 index. That's a good sign. A healthy stock market is a stock market where there's broad participation, not being driven by 5 or 10 stocks. So the quarter's almost over. We'll have more here soon with our quarterly commentary. But we would say here that probably we're at an inflection point. We like the idea of overweighting the cheaper parts of the market, underweighting the frothy, expensive parts of the market, holding some cash for safety, and also holding some bonds, which are typically a good hedge against stock market volatility. With that, we'll end here. Have a great day. Speak soon.